History doesn't repeat, but it does keep a pattern. Stand at the top of any empire at its peak, and everything feels permanent. Rome at its height, marble everywhere. Legions undefeated, trade routes stretching across continents. No one inside that system believed they were living in the middle chapter. They thought they were the final version. They weren't. The same confidence lived in Constantinople behind the Theodosian walls. It lived in the Ottoman court at Topkapi Palace. It lived in London when the sun never set on the British Empire. Every superpower believes it has broken the cycle. None of them did. In 1976, a British historian named John Bogot Glubb published an essay called The Fate of Empires. He studied 11 major powers across 3,000 years. Assyrians, Persians, Ottomans, British, different cultures, different religions, different technologies, same lifespan, roughly 250 years. 10 generations, not exact to the year, but close enough to be uncomfortable. Then the age of conquest, expansion, confidence, momentum, then commerce, trade networks, financial systems, real wealth, then affluence, peak prosperity. Comfort replaces hunger, then intellect. Bureaucracy grows. Debate expands. Complexity increases. Finally, decadence, division, excess, debt, cynicism, the names change. The pattern doesn't. Now here's the part that matters. The United States declared independence in 1776. 2026 marks 250 years. That doesn't prove anything by itself. But when you overlay economic data on top of historical patterns, the symmetry starts to look less poetic and more mathematical. Let's strip away emotion and look at structure. Empires rise because they are productive. They make things, they innovate, they trade. Their currency becomes trusted. Eventually, that currency becomes dominant. And that's where the trap begins. When your currency becomes the global reserve, you gain what economists call an exorbitant privilege. You can borrow cheaply, you can print money to buy real goods, you can run deficits without immediate consequences. It feels like winning. It's leverage. That leverage can be used carefully or abused. Look at Rome. During the Pax Romana, the backbone of the economy was the denarius, a silver coin. At first, it was nearly pure silver. That purity imposed discipline. The government couldn't spend beyond its means without acquiring more silver through taxes or conquest. But expansion slowed, revenue flattened, costs didn't. So emperors made a quiet change. They reduced the silver content. Under Nero, the coin was diluted. Under Marcus Aurelius, diluted further. By the 3rd century, the denarius was mostly bronze with a silver wash. Money supply increased. Value didn't. Prices exploded. Trust collapsed. Trade shrank. The middle class was crushed. Rome wasn't destroyed by barbarians first. It was hollowed out financially. Now jump to 16th century Spain. In present-day Bolivia, the Spanish found the mountain of Potosi, one of the largest silver deposits in history. Galleons shipped vast quantities of silver back to Europe. Spain thought it had discovered permanent wealth. But money is not wealth. Wealth is productive capacity. Farms, industry, skills. Spain flooded its economy with silver. Inflation followed. Domestic manufacturing withered because it was easier to import goods with freshly minted silver than build factories. They confused currency with capability. When silver flows slowed, Spain had debt, inflation, and a weakened industrial base. It defaulted multiple times under King Philip II. Now look at Britain. At the start of the 20th century, the pound sterling dominated global trade. Aslan was the financial center of the world. Then 2 world wars changed the balance sheet. Debt soared past 200% of GDP. Britain liquidated assets. It borrowed heavily from the United States. The breaking point wasn't a battlefield. It was 1956. During the Suez Crisis, Britain attempted to assert military control over the canal. The United States, under Dwight D. Eisenhower, opposed it. America didn't send troops. It threatened to dump British currency reserves. The pound would have collapsed. Britain backed down. That was the moment the empire ended, not militarily but financially. A superpower can project force only as far as its balance sheet allows. Now turn to the present. The United States holds the global reserve currency, the dollar. That status has allowed decades of trade deficits, military expansion, and deficit spending without immediate collapse. Since 1971, when the gold standard ended, the dollar has been entirely fiat, flexible, expandable. Federal debt has crossed $36 trillion. Interest expense alone is approaching, and in some periods exceeding $1 trillion per year. That is not ideological. It's arithmetic. When debt compounds faster than economic output, the gap must be closed somehow, through growth, through austerity, or through currency debasement. Here's the mechanism most people miss. When a government accumulates massive debt, it enters what economists call fiscal dominance. That means monetary policy becomes subordinate to debt sustainability. The Federal Reserve officially fights inflation and manages employment. But if interest rates rise too high, federal interest payments explode. Raise rates aggressively, and you risk bankrupting your own treasury. Lower rates artificially, and you risk inflation. That's the trap. Rome debased coinage. Spain flooded markets with silver. Britain devalued the pound. The tools change. The incentives don't. Now layer on deindustrialization. Over decades, the U.S. outsourced large segments of manufacturing, specialized in finance, services, and technology. That's not inherently fatal, but it creates vulnerability if financial dominance weakens. If global demand for dollars slows, whether through geopolitical fragmentation or alternative payment systems, the ability to run persistent deficits becomes constrained. Foreign buyers currently hold trillions in U.S. treasuries. If they reduce purchases, domestic buyers must absorb more debt, or the central bank does. If the central bank monetizes debt aggressively, inflation risk rises. Inflation doesn't hit evenly. Asset owners often benefit first. Hard assets appreciate. Equities rise in nominal terms. Wage earners lag. That gap fuels political polarization. Late-stage empires don't collapse in unity. They fracture internally first. You can see this pattern in the late Roman Republic before Julius Caesar. You saw it in Weimar Germany during hyperinflation. Economic instability amplifies social division. Now step back. Is collapse guaranteed? No. History provides patterns, not prophecy. The United States still has enormous advantages: deep capital markets, technological leadership, military reach, demographic flexibility compared to many peers. But no empire in history thought it was the exception. The risk is not sudden apocalypse, it's gradual decline in purchasing power. Rising interest burdens crowding out productive investment, increasing financial repression. Subtle capital controls, slower growth, masked by nominal asset inflation. Empires rarely fall overnight, they fade through managed decay. The dangerous illusion is believing that reserve currency status equals immunity. Spain believed silver meant permanence. Britain believed naval dominance meant permanence. Rome believed legions meant permanence. Each discovered that financial gravity eventually reasserts itself. The real question is not whether history repeats mechanically. It's whether we recognize the incentives driving the system. If debt continues compounding faster than productive capacity, adjustment becomes inevitable. The only variable is how orderly it is. Every empire thought it had engineered a permanent system. None had. So here we are, approaching 250 years. Not destiny, not prophecy, just math, incentives, and human nature. The cycle doesn't ask whether you believe in it, it only asks whether you understand it before it finishes turning.